Welcome and thank you for joining us for our first money management session. This webinar is designed for those seeking to better understand how to manage their finances and learn about investing to secure a financial future. So O'Brien Financial Advisors provide holistic financial planning advice that will help you create your ideal life. We do this by understanding what you want to achieve and work with you to tailor a plan that will suit your individual needs. My name is Tracee and I'm a financial advisor here at O'Brien. So feel free to send through any queries, which we'll answer at the end of the webinar. Today, we also have Lisa on call to just assist with any technical queries. So before we start, we're just going to go through a disclaimer that this webinar is general information only and does not take in consideration your personal circumstances, financial situation, and needs. Just turn it off. So just go through the agenda that we'll go through today. So today we're going to go through a few topics which will start from basic bankings and setting up your buckets, methods to repay any credit card debts, managing your needs, wants, and savings, investing inside and outside super, common investment types available, and the effects of compounding. So before we start, we're going to go through a little poll. So you should be able to just have a look at your poll that pops up now. And the question is, when was the last time you reviewed your banking? So the options are 1 year ago, 2 years ago, year 12, or never. Just close the poll. And the answers that we have here is about 1 year ago and 2 years ago seems to be the common answer. So just start there. So at the moment, our cash rate is at a historical low of 0.1%. And a lot of people, for example, haven't reviewed their banking needs for the last 1 or 2 years. I guess the reason is you have to try and search for no banking fees, no ATM fees, or even just an interest earning accounts that would suit your need. Because if you don't look, you don't really get what's available. And where you can start is actually just looking at finders.com.au, savings account, and the options for high interest savings account. We're not encouraging you to open a new account every 3 months, but to actually find an account that suits your needs. For example, some accounts will require a monthly deposit condition. This can be $1 or $2,000 or up to $2,000, plus the number of transactions each month. So the idea here is to just be aware of what you can get and have a look at your options as well. So here's an example as well, it's just on $5,000 initial deposit and $1,000 savings plan each month. These are some of the options that are available in the market these days. And if you're under age 30, for those between the ages of 18 and 29, there's the option for Westpac's account, which is actually earning about 3% for you at the moment. The next topic we're going to look at is setting up your buckets. So what does that mean? It means dividing your income into different bank accounts for different purposes. For example, as your income comes in, account 1 could be for your daily expenses or needs. You could actually name that account as serious business, if that would help. Account 2 is for your wants or splurging. You can call that treat yourself. And then a third account where it's harder to access, you can call it no touchy. So the idea is to make the last one hard to access and to use those funds for wealth creation for the longer term. You have the option to automate your income to be directed to these accounts when you receive your regular salary. The idea here is to only spend what you have allocated in each account, and if it's not there, you cannot spend it. So how does that benefit you? You can start to understand how much you're spending on things, fixed expenses and variable expenses, and help build a plan around saving. And the option is this, to have the transactional account only linked to account 1 and account 2, so then you don't touch your long-term savings account. The next topic we're going to talk about is debt management. So there's a common question on how to repay balances on credit card debt. So which should you focus on? The debt with a higher interest and a higher balance first, or the debt with a lower interest or lower balance first? The answer to this one is to go with the one that will motivate you to repay your debt quicker. For example, if saving on interest will motivate you to direct more funds towards repayment, then proceed with option 1. If clearing a credit card debt will motivate you more, then proceed with option 2, because that's the debt with the small balance. Alternatively, you can consider balance transfer. That means you're transferring your credit balance to another credit card provider that offers an interest-free period. So for example, there's some that offers a 12-month interest-free period. You can have 12 months to repay your credit balance without accruing more interest. The idea here is to work with what will encourage you to repay your debt quicker. And how does that benefit you? You can be debt-free sooner, and with debt-free, you just have less stress on that. Another topic that we're going to look at is just managing your needs, wants, and savings. Similarly to creating separate bank accounts, you can then start looking at what your needs, wants, and savings are. So what are needs? Needs are generally housing, utilities, bills, groceries, insurance, and medical. What are wants? It's normally entertainment, eating out, or treating yourself. And generally, savings is just for your emergencies, large expenses, investments. So as you can see, normally savings is the last thing that we consider because we always put the needs and wants first. So how do we get ahead? An option is to just flip your priorities and having a 20, 50, and 30 plan. So what that means is that you allocate your 20% to savings at the start, and then you work off the remaining balance for your wants and needs, which can be adaptable as well. So for example, for a new graduate with a starting salary of 50,000, living at home or renting will make a big difference. So you might have to allocate more funds towards meeting your needs as opposed to your wants. The idea is to make your needs and wants be adjustable and not touch the savings in order for you to have a long-term savings plan. So where can you start? The option is that you can go to moneysmart.gov.au and use their budgeting tool to help you understand what your fixed and variable expenses are. That way you can also just adjust them accordingly as your income increases. So next topic that we're going to look at is introduction to investing. So we're going to start with another little poll here. So poll question is, have you started investing? Yes or no? So majority of our attendees have actually answered yes today. For the ones that normally would say no, you would have if you started having super. So superannuation guarantee contribution is currently 9.5%, and there's actually more than what some people are currently saving. And this is expected to actually increase to 12% in 5 years' time. So just based on a basic salary of 50,000, that would be an increase from $4,750 being allocated to super to $6,000 being allocated to super. That's actually more savings than some people set aside for themselves. So right now, I'm going to just go through the differences in investing inside and outside super. So when it comes to investing inside super, the income is taxed at 15% now, and it's generally tax-free in retirement. The only issue is that it's inaccessible until reaching preservation age. And for those born after 1st July 1964, that would be age 60. So while it's inaccessible, it's quite important to ensure that invested in line with your risk tolerance. So the risk tolerance is your appetite for risk. So for simplicity's sake, under age 40, due to your available investment timeframes, you could consider investing in growth or high growth. That means that you have a higher allocation towards growth-oriented assets such as Australian equities and international equities or shares, as opposed to defensive assets such as cash and fixed interest. And that's because you have a longer time frame to recoup any losses if that happens during your investment time frame. There is an option as well to invest outside super. Income earned is taxed at your marginal tax rate, but it is accessible at any time. There are discounts available as well on capital gains, both inside and outside super. And you should also look to consolidate your super if you have multiple super accounts with no insurance cover. So we'll just go through the next one, which is just the common investment type and how they work. Today we'll go through direct share investments, exchange traded funds, and managed funds. So direct share investments, also known as stocks. Australia has one of the highest share ownership in the world, either directly or indirectly. Indirectly being sometimes in your super, where your super fund purchases the direct shares on your behalf. So when you buy shares, you provide capital funding in exchange for a portion of that company. You become a shareholder. Some of the advantages of that, there is a low startup cost. There's many share trading platforms available without advisors. You have a higher degree of control as you have voting rights for it. There's franking credits as the companies pay tax of 30%. And it's convenient and transparent as it's traded on the ASX. The ASX being the Australian Stock Exchange. Some of the disadvantages of that is that there's a lack of diversification, as all your eggs are in the one basket, which is the one company you invested in. It's generally 100% growth as it is one company, and therefore higher risk. There are also brokerage costs involved in buying or selling shares. Next, we're going to go through exchange traded funds. How that works is that it pulls together money from many investors to invest in securities such as shares, bonds, and short-term debt to track an underlying index. An index is a method to track the performance of a group of assets in a standardized way. Some of the advantages of that is that it's cost-effectiveness of share trading, as it is also traded on the ASX, but it also offers diversification. It combines investment advantages of managed funds via access to markets and access asset classes that you might not otherwise have access to. This means that you're not putting all your eggs in one basket to reduce risk over time. Similarly to direct shares, it is convenient and transparent. It's traded on the ASX as well. Some of the disadvantages is that it will never match the index completely. And there's volatility as there's currency risk of selected ETFs that has overseas exposures. So another one that we'll go through is managed funds, which is more commonly used as well. With managed funds, your money is put together similarly to ETFs, and a fund manager will buy or sell assets such as shares and bonds on your behalf. So you don't own the underlying investment, you own units in the fund. So example is if a unit costs $2 and you're investing $10, you get 5 units. Some of the advantages of that, it offers diversification because all your funds are not invested in the one asset class. So it's invested across different asset classes such as Australian equities, international equities, cash, and fixed interest. It's expert management because it's being managed by fund managers. Some of the disadvantages of that is that there's buy sell cost involved. There's ongoing fees involved due to management costs that you pay the fund managers. And some of the investment is minimum investment requirements, such as between $5,000 to $10,000 generally. So why should you invest, or why should you consider even direct shares, exchange traded funds, or managed funds? So we're going to just talk about opportunity cost. What is opportunity cost? It represents the potential benefits you miss out on when choosing one alternative over another. So from our first session at the start, I mentioned that the cash rate is at a historical low of 0.1%. So an example is that if your savings account is earning a 1.5% per annum, that is if you've reviewed your banking needs and changed your bank account to one of the ones that are offering a higher interest, and an average return for a balanced investor over life is 5% per annum, your opportunity cost is therefore 3.5%. So that's what opportunity cost is. And the next topic we're going to talk about is just on compounding effect. So in this example there, we have an investor one starting investing at age 25, setting aside $5,000 per year over 10 years, and don't add additional investments after age 34. And we have investor two starting at age 35, setting aside $5,000 per year for 30 years. At age 65, you can see that due to the effect of compounding, which is the process of which an asset's earnings or capital gains or incomes are reinvested to generate additional income over time. Investor one has a balance of $787,000 at age 65 as opposed to investor two at $612,000. Warren Buffett, who's commonly referred to in finance, has a net worth today of $80 billion. He started investing seriously when he was 10 years old, and by the time he was 30, he had a net worth of $1 million or 9.3 million adjusted for inflation. If he was more of a normal person exploring the world in his teens, and by age 30 had $25,000 to invest, his net worth would be about 11.9 million today. That's actually 99.99% less than what his actual net worth is currently. So summary of this session is that to review your banking accounts and just to earn some interest on that, setting up separate bank accounts to better understand your expenses and to help you save. And there's options as well to repay your credit card debt and be debt-free. And setting aside 20% of your income for savings and investing, and leaving off 80% of your income for your fixed and variable expenses. Talk about reviewing your super, investing in line with your risk profile, consolidating where appropriate, and also understanding your investment style. And where required, seek professional advice. So in our next session, we're going to hear from our panelists. We have Rory Secom from Own Home Loans, Zeno Kubica from Viva Property, and Elizabeth Michael from City Pacific Lawyers. So now we'll just go through any questions that you guys have.
Thanks, Tracee. The first one is, what are your recommendations for young professionals, given that they may have a low salary and it's harder to build wealth?
So I'll just start my camera. So I guess the thing is with young professionals, the thing that we don't really spend a lot of time on is on budgeting. So actually trying to understand what our fixed and variable expenses are you're able to then identify where you can improve or even, allocate additional funds towards savings. The plan where we put 20, 30 and 50, it actually helps a lot when it comes to saving for the longer term, because you then realize how much you're actually spending on your variable expenses, and then you will be able to adjust it as you go. The next one.
Yeah, we just have an attendee question asking, should I pay off my help debt as opposed to accumulating savings for a home?
So when it comes to help debt, unless you're earning a high amount, a lot of that it's earning a very low interest. So it's more better decision, I guess, in a way, to actually just invest or save that as opposed to paying off your help debt. Because touch wood, like if you're not there, you don't actually need to repay the debt if you, for example, pass away. So that's a bit morbid, but that's the reason why a lot of people don't pay off their help debt unless they're earning a certain level of income. Hope that helps.
And the final question, Tracee, you talked about diversification when you were talking about ETFs and managed funds. Why is diversification important?
So diversification is important because you're not putting all your risk into just the one type of asset class. So for example, if you're investing into just direct shares, a lot of them are just high growth. So if that one company performs well, you get the returns that you need. Whereas if the company just had a legislative change that affects it, for example, if there's a lot of exposure to one country and that country kind of just puts a new legislation in place that halts the growth in income earnings over the next few years, that's all your risk and all your funds in one investment. So diversification actually just spreads out all the risk. So when one investment is not doing well, the others can boost it up as well.
Okay, that's all the question and answers, Tracee. But how would people be able to seek further advice if they want it after these sessions this week?
Yep, so if you're looking for advice, you can actually just email us at admin@obbc.com.au as well. Just be in touch and we'll set up a no fee obligation initial meeting with you, and just to better understand what you're trying to achieve as well. So thanks everyone for joining us today, and look forward to the next session on Thursday.